Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. There were a slew of economic data yesterday, and the result was dollar losing further of its steam. Dollar index dropped to 103. Germany's inflation figure, it is significant because it is an important economy in the eurozone. If the inflation is consistently coming higher, it might mean ECB has more work to do to control inflation. ADP private payrolls, which came in lower than expected, and also the US GDP data was released yesterday. JK, lots of data to chew over. How are you reading it? I'm sure Fed will be happy to know the labor market is easing. What do you think?
Good morning, Swaraj. Yes, economic data is coming thick and fast this week, particularly from Tuesday onwards, and more to come today and tomorrow. Uh, but what is also observed is that market moves may not be exactly reflective of the real analysis of the data, because we had very skewed moves in the markets yesterday. The yields fell, but if you look at the currencies, there were divergent moves between currencies, euro and GBP gaining a lot. Yen actually holding on near about 146 levels, and the Chinese one is also trading closer to 7.30. EM currencies were not really taking cues from the yields falling. So that's reflective probably of an illiquid market, which is probably driven only by positioning. Now, yields did fall quite a bit following on the weaker number previous day, and then the GDP and ADP number yesterday. In fact, they have been moving so swiftly both ways that the big players have been keen to reverse positions within a day, and that's creating even more volatility. But the session low in yields were less than an hour after the CME open, as the sellers have swarmed amid the profit taking by hedge funds yesterday, and even the real money accounts were buying again. Now, the data from US did not really disappoint the bond bulls. Actually, before that, yields had been slightly higher after the German and the Spanish inflation, but they were immediately after US Open. The sellers, or rather, the bond yields came down with the data being announced. The second print on QT GDP was not as strong as the first estimate, and it was at 2.1% versus 2.4% that was being projected earlier. Inventories actually flipped down. Capex were also revised lower. Only the private consumption was holding up. Good news about the GDP was that there was a downward revision to the GDP deflator, as well as the core PC price index, both coming lower, is again adding to the dovish feeling in the market. Also, ahead of non-farm payrolls, we had the ADP employment data, which provided another piece of evidence of cooling US labor market. August number revealed 1,77,000, below 195,000 expected, and that's the lowest in the last 5 months. Now, ADP series is, of course, not such a reliable indicator of what the non-farm payrolls will be, but it definitely adds to the feeling that job market is cooling off, particularly coming on the heels, close on the heels of the JOLTS data earlier this week. In JOLTS data, of course, the quits rate was very significant, because it's more significant than the job openings, because that shows the inability of people to find alternate jobs, and therefore the labor market is seen to be quite tightening. We, of course, had some data from China also this morning. PMI manufacturing showed, continued contra. I mean, PMI manufacturing actually improved, but the services actually contracted. Services contracting has been the latest trend that has been seen in most major economies. On the stocks, they have been steadily gaining, irrespective of the way the data is directing. Of course, they really did not have a rip-roaring rally after these weak numbers and the fall in the yields. Now, weaker news on the economy is, of course, grabbed as much as the good news on the economy, as that is presumed to bring forward the rate cuts and increase chances of continued pause. Some would even argue that the economy is achieving a soft landing. While the growth is not crumbling, things are cooling off enough to possibly moderate the price pressures. But all these bullishness can vanish if we get a hot PC inflation number today, and the Fed places a lot of weightage. If you look at it from a month-on-month perspective, major indices in the US and global have actually been on the losing side. So compared to last month close, if we do not have any much larger rally today, we will actually be seeing a month-on-month weaker close for the stock index as well. Now, reaction in the forex market, as I said, have been at odds with the weak data that we have seen. Yields have actually fallen, like nearly 25 basis from the previous highs, but Japanese yen, which should have ideally, gone even below 145, is holding there 146. Chinese yuan still trades around 730. And EM gains have been very, very muted. If you look at the reaction to the yields falling, even the euro has gained much, more than 1%, and that is normally seen in month ends, as we see a lot of euro GBP buying due to interest repatriations that we see. And commodity currencies have just recovered part of their oversold conditions. So just like stocks, even DXY is heading higher on a month-on-month basis, despite the fall in the yields. And possibilities are that lack of participation or caution ahead of more inflation data or weakness of other economies could be dominating. But we will only know once the market opens, post Labor Day weekend, that is on Monday. Dollar weakness spurred by the weak data, of course, is very, very muted, and that's reflective probably of the positioning in the market as well. Now, on the rupee, lack of reaction to US data owes a lot, not only to the steadier dollar elsewhere, but also to the steady outflows seen over the last few days, while sellers seem to be holding off for better levels. It's also to be noted that Indian equity indices have closed in the red in August, or almost about to close in the red, because we have one more trading session left after 5 months of incessant rise. Now, FI flows in August have been the lowest in the last 4 months. Another observation I have is that USD traded above 82 for the first time in September 22. And every month since then, it has always pierced 82, below 82 rather. And when it traded in the historical low of 83.25, also, even on that month also, we have seen a trade below 82. However, this August is the first month when rupee did not trade below 82, or rather held above 82 for the entire month. And clearly, keen buying is emerging on shallower dips. I would be keen to see if this is an exceptional month or a precursor to a fresh uptrend. A lot will depend on the domestic market performance and the global risk sentiment. Let's wait and see more data, and then possibly we get a directional move next month. Next month. Thank you.
Thank you, Jake. And very interesting how the reaction to various data is being taken in the markets. So, as you said, there is not a proper reflection of the interpretation of the data. For example, yesterday, dollar lost against DM currencies like GBP and Euro, while EM currencies like Yuan remained on the weaker side against the USD. Yesterday, US bond bulls had a good time as yields came down after the ADP and GDP data. Today morning, we had the Chinese data, manufacturing PMI improved, but services contracted. Services contracting is a trend we have been observing across economies. Today, of course, is the PCE number, which will be keenly watched, and a hot number can lead to some more rally in the dollar. For the rupee, we had a lack of reaction because of steady outflows, and a very interesting insight provided by JK that this August is the first month where 82 would not be broken on the downside. Like up till now, right? We just have one more day, and even Indian equities, after 5 months of continuous rise, Indian indices might be possibly closing in the red for the month of August. Very interesting sets of insights. That's it from us today. Tune in tomorrow as we bring you the fresh updates from the financial markets. Thanks for listening.